Hi guys, welcome back to Clearing Spotlight, where markets meet clarity and institutions navigate liquidity, risk, and infrastructure. In this episode, we will discuss the current state of decentralized finance and where this means for the industry. Today, we are joined by an expert in the field, James Aitchison, CIO and founder of Caerus Global Management. James, nice to meet you. How are you doing today?
Thank you for having me on the show. Yeah, very excited about today's podcast.
Me too. It would be great that if you can give you a briefly intro for our viewers and listeners.
Yeah, sure. So James Aitchison, I'm the CIO of Caerus Global Management. We're an on-chain DeFi hedge funds, multi-strat, mostly focused on on-chain liquidity. We've been operational since 2019. We are a crypto native fund, so we don't trade any TradFi at all pretty much on-chain. And previous to that, I had about 17 years as an investment banker, so I'm a reformed TradFi careerist.
Thank you very much. So before we jump into the state of DeFi, let's start with a few questions to you to get to know you better. Like I bet our audience would like to see how an expert mind thinks on the fly as well. So the first questions, what's the first thing you check when you wake up? Markets, your messages from WhatsApp or Telegram?
I would first of all, I would probably say, yeah, unfortunately, I'm straight on CoinGecko and checking BTC and ETH prices, and not just at 6 a.m. when I wake up, generally at 12 and 3 and maybe 6 as well. So I'm generally up through the night as well, checking on things.
Okay, cool. So for the last one, if you could explain DeFi to your grandmom in one sentence, what would you say?
Peer-to-peer finance, where you could own a stock, it could be crypto, but it provides you the ability to do something extra and receive an extra return above and beyond just the price action.
Okay, thank you, James. I like where it's going. So let's get right into it. I'm excited to hear about your insights, given your time and expertise in the industry. So how would you describe the current stage of DeFi as we approach the end of 2025 right now? Has the space grown since its earlier speculative space as you expected?
Hugely. So I think one thing you have to understand is the true innovation begins DeFi, I should say. So there are very little barriers to getting up and starting. So to think about the ecosystem of DeFi, it's like a fragmented marketplace of small fintechs. And because of generally, if you think about fintechs, very low, generally not sort of balance sheet rich organizations, generally quite talent rich. If we sort of think about how technology has evolved, and if you think about scalability, interoperability, and composability, we've just seen huge, how should we say, growth and improvements over the last 12 to 24 months. So on the scalability, we had EIP 4844, which was launched early in the year. This dramatically reduces the roll-up transaction costs for L2s and the EVMs that feed into the Ethereum ecosystem. So gone are the days. I remember paying $500 per transaction at some point on Ethereum L1s, going back to sort of 2021,
Wow.
which is obscene. I'd say principally one of the major ones has been Circle and its CCTP, which is its cross-chain technology. Now, previously what used to happen was that to move native Circle USDC from Ethereum to an L2, effectively it had to be bridged and minted. Now that introduced huge amount of bridge risk. So effectively that the USDC was just like an IOU on the L2 and was still sat on the L1. Now with that interoperability, that removes that huge risk. And so at Caerus, we're using this technology daily. It has massively improved our workflow, not just across the EVMs, but across Solana's, the Move technology ecosystem, such as Aptos and Sui. And then on the composability side, there's been huge work around intents and solvers. So what one is able to do now is to basically go into protocols on the blockchain and be able to say, this is my problem which I want to be solved. And then solvers are coming and providing quotes and liquidity. So a classic case is around, I want to sell 100 Bitcoin into USDC. Being able to go into an aggregator quote and then receive various solvers coming back with quotes. And that's a big change from like 12 to 24 months ago. So all in all, big strides.
So from your hedge fund vantage, how do you think about risk in DeFi differently than in traditional finance? How do you model and manage those?
Good question. This is what keeps us up at night. Let me maybe break it down to how particularly DeFi is so different to TradFi. So probably the most famous one, which gets the headlines, is smart contract risk. So being hacked. You're effectively most of the time handing over custody of your asset. So then you're having to rely on their security standards as well. So smart contract risk is huge. Another aspect of it is oracle risk, which became quite well known of the incidents of 1010. Now, the way that's tried to be solved has been that there's been providers such as like Chainlink, which will take multiple feeds, coming to provide like an amalgamated price feed. Then we also have risks such as peg risk. So again, is the asset holding up to the value of the asset? So with a stable coin, is it trading around $1? And then I guess finally, it would be the governance risk. So the risk is it comes at you from a lot of different other areas, say, compared to like a TradFi industry.
True, that's true. So we've talked about the DeFi has grown and the impact it's having across the financial landscape right now. But one of the most interesting part about this is how it intersects with traditional finance. James, you have been spending like years in both categories, both TradFi and DeFi, investment banking and digital assets as well. So let's explore how those two sides are starting to connect as you see. Coming from investment banking, what parallels do you see between traditional markets and the DeFi ecosystem today?
I think there are parallels and there aren't. So there are parallels in that if you just look at it from a career standpoint across the industry, being based here in Hong Kong, for instance, there's a huge amount of talent which has moved over from TradFi, brought their expertise, their work ethics, their integrity, their just that technical knowledge, and then applied it to blockchain and to crypto. So there's clearly a huge amount of overlap. And this is not just Hong Kong, this is globally, right? You see some of the biggest, best operators are ex-TradFi or are hybrids and still operate within TradFi. But saying that, though, I do feel that CFI is more of is quite often sort of described the gateway drug, and it looks and feels a lot like TradFi in many ways, with the central limit order books, very easy user interfaces. You don't really have to deal with wallets. That's the whole point of CFI. Makes it all very very user friendly. But where versus with DeFi, it's particularly different. If you think about when the industry started off, and you either used hot wallets or you had to use like ledgers or keystones, or you had to have a physical offline wallet. Now, port that into TradFi. I mean, you know, how do you run $1 billion hedge fund and then say who's got the ledgers on the weekend, right? So now there have been attempts and there are solutions that have solved that, but I think the important point was that they came after effectively a retail way of creating a financial a blockchain with smart contracts and the like. So you consider that blockchain is 24/7, 365. You consider the sort of fragmentation around blockchain. You consider the lack of third-party intermediaries. I think it is different enough that it warrants not just being a TradFi 2.0, but actually understanding so that this is a totally separate financial system which has been created, and to give it the respect which it deserves.
I do agree with you. You just mentioned about like DeFi is totally built on like coding and like open ledgers, like what Vitalik has been doing, like their computer people, like developers. So while TradFi is almost usually built on trust and relationship and regulations, how would you see the differentiation between the trust with the DeFi, these kind of two sectors?
Yeah, good question. So TradFi is built on strong regulations, strong customer protection, strong legal frameworks, segregation of responsibilities. So you have, clearers, you have custody, you have exchanges, for instance, whereas a centralized exchange does all that. But whereas in DeFi, there is still trust, but it is cryptography trust, it is algorithmic trust, and that trust is then redistributed across validators, across auditors, across protocols. It's a very, very different way of operating. So TradFi provides, because of the trust factor and, for instance, the ability to develop, say, credit scores and credit ratings, so having effectively a financial borrowing history. That sort of singular entity, or even if it's at corporate level, doesn't really exist as well in DeFi. So TradFi suits under collateralized lending particularly well. So that is where, maybe, so again, use a simple example, with a mortgage, I go down $100,000 and buy $1 million property, right? So the bankers obviously sits as the senior lender, owner, but there have you. Where crypto works really well is over collateralized lending, and also the accessibility. On-chain activity or on-chain finance really provides very quick 24/7 seamlessly trustless execution. And I guess it was also you have to understand that because of the algorithmic nature of decentralized finance, where code is law, so because we don't necessarily have like governable laws in the TradFi sense to fall back on, so code. So that manifests itself, in a particularly infamous one around liquidation events. And so in on-chain, where you have, say, health factors and rules around lending, so there are pros and cons, and I think the future will be a meld between the two.
Since we are talking about lending, like collateralized in DeFi, if that's one point that you want them to do improvement, which part that you want to do?
We need to better improve the user experience, and particularly around, say, something like onboarding. Because generally DeFi is the sort of second, third step in the evolution of participants, whether it's retail or a institution, their experience. So it takes a bit more to sort of go on and learn how to set up wallets, integrate wallets, set up the necessary security, the policies, and the like. Now, these are all sort of operational steps, which I think most people don't necessarily think about or want to do. They generally would just think, I want to go buy Bitcoin or Ethereum or the like and find the easiest way to do that. So they're quite often looking for an experience which mimics their current TradFi experience, say with an app in a phone. So I think we can get a lot better at that. There are a lot of efforts being made at that. So you're now finding, for instance, in the mobile wallets, say Rabby or MetaMask, that whereas before there was sort of simple transaction tools, that they enabled swaps within them. So you'd actually be able to not actually have to go to a router or like a 1inch or a DeFi Llama. You'd actually do it within the wallet itself. Now they're enabling perpetual swaps within the wallet. So they've bootstrapped into Hyperliquid and their code, and enabling the positions to be created, or short, longs, etc., within the app itself. It's a lot going on.
Yeah, that's kind of interesting though, because I'm more focused on CeFi right now. But it's good to have you here to give us more like insight for DeFi. So, but still, like institutional access to DeFi remains cautious, but growing a lot recently. It also amplifies that the needs for robust governance structures, as we just mentioned. So as a result, regulatory bodies are increasingly focused on balancing innovation with safeguards that ensure fairness, security, and consumer trust. I think, what do you think are the most significant barriers to large-scale DeFi adoption today?
Without a doubt, custody, credit risk. So DeFi has, I think, a particularly bad rap on the safety aspect. So, we've had some very big hacks. I just kind of think the hacks are a bit like shark attacks, where they don't come very often, but when they do, they're particularly they make massive headlines. You think like a shark attack in Australia, right? But reality is that they're quite infrequent. But can be very nasty when they happen. Now, I guess the sort of the story which is behind that, though, is that actually where I've seen the largest amount of development in crypto is around smart contracts, particularly on EVMs and the auditing standards and the standards which are improving around that. So actually the 2025 has seen a significant amount of reduction in smart contracts versus 2020 and 2024. So where we had about $2 billion. So now there are ways in which we mitigate that to a certain extent. We deploy third-party security firms which monitor a lot of the protocols constantly, 24/7, 365. When we are choosing to deploy capital in protocols, we will use software which we can then evaluate smart contracts for potential weak points or backdoor reentry attacks. There is a natural evolution which happens where they will move from CeFi and then see some of the opportunities which exist in DeFi, and then look to then move up the risk curve. This is definitely more risky, but move up the crypto DeFi technical curve as well, and become more on-chain, and realize the superior benefits of DeFi that it offers versus some of the existing tools and financial products which they've been using.
So do you think that it is a right balance between protecting investor and encourage innovation in DeFi, as you just wrap up about?
Yeah, I think you've basically got the yin and the yang. So TradFi in its current state, I think we can quite argue is over-regulated and over-protects, which stifles innovation. And then we've got, on the other side, DeFi, which has sort of been a sandbox which has been created, which has had amazing innovation, but then it has some very large fallouts and errors. The truth is that the answer lies in the middle, and that both systems will do things which are which are certain advantages to different types of products. So I do think that regulation will benefit from some consistency from some of the leading regulators.
Let's say if we project 5 to 10 years ahead, do you foresee DeFi can be integrated into regulated financial system like banks, custodians, asset managers, or being forced to retreat or adapt under regulatory pressure?
Well, I think it's already there in some regards. We already have banks which are tokenizing assets on chain. We're starting to appear on their radar, which is good. But if you sort of think, I guess you've got to think about it. So as I mentioned before, so DeFi's TVL sits about 282 billion. JP Morgan's balance sheet is about 4.3 trillion. So we're 6.5% of JP Morgan's balance sheet. The point being there, I think, is that it is our job and it's incumbent on us to keep on growing this industry so that the incumbent players start to realize that we cannot be ignored.
How would you encourage institutional players who are still on the sidelines, watching DeFi evolve, but still hesitating to engage?
You can't get in the way of progress. You have to identify that this is a technology that is here to stay and is growing in importance. You know, there is a huge amount of players trying to develop stable coins, and not just crypto natives, but you've seen Ripple, Walmart, PayPal. So these are household names. But then on a more molecular scale, is that you get comfortable with how DeFi operates. So DeFi operationally is intensive, and there are a lot of steps. And of course, there's some general sort of very sensible but very obvious sort of advice of just start very small, go on chain, do some over-collateralized lending, give yourself some relatively high health factors. But I always think that there is no better way to learn than getting your hands dirty, like in anything in life.
I agree.
Right, to go do. Actually go do. Don't sit and pontificate. Go do. And then realize the power of what this exists and the opportunity set of touching, because the DeFi it cannot be shut down. And so, if we think about like what is one of the main differences between DeFi, and I'd argue crypto, but I'm going to put my DeFi hat on, and TradFi is the removal of the middleman, the renter class. So the power of DeFi is effectively removing that third party, acting like a peer-to-peer network to connect the buyers and the sellers of what have you. And so everyone wins, well, apart from that sort of legacy incumbent third party system that doesn't exist anymore. So we have created a financial system, the best ever, that enables the buyer and the seller to interact with a very, very small slippage and together on a permissionless, anonymous way.
So I hope that this episode could convince more people to join DeFi or like just have a try on crypto or like digital assets area. So before we wrap this up, today's episode, let's play a quick this or that games, James. Like this will be a very quick Q&A for you and just 2 options, and then I will give you 2 choices about DeFi. Do pick one that under a second. Cannot be long, okay? The first one, ready? Bull market hype or bear market building? 1 second.
Bear market building.
Okay. Bitcoin or Ethereum?
Bitcoin.
Checking charts every 5 minutes or pretending you don't care?
First
one, okay. Blue chips or degen plays?
Blue chips.
Okay. High risk or low risk?
Low risk.
Okay, thank you very much. It's been great pleasure speaking with you, James. Thank you so much for joining us on Clearing Spotlight. And thank you for our viewers and listeners for tuning in. Make sure to stick around. We have more episodes in stores. Wherever the market moves, we will be here to keep things clear. Thank you. Goodbye.